So what I wanted to start with here today is just to take a look at some of the macroeconomic leading indicators. So there's been all this talk in the news about recession. Are we going into a recession? Are we not going into recession? Are we already in a recession? And so to answer that question of where we're headed economically, what we like to do at ITR is look at these same 12 leading indicators, rain or shine. These are the 12 most predictive inputs about where the US economy is headed. And so you can see on your screen there a variety of different inputs. We have some that you're probably very familiar with. The Purchasing Managers Index, for example, put out by the Institute for Supply Management, is one that's regularly makes the news and is commonly followed by a lot of folks. And then maybe some that aren't quite as commonly followed, but we really love here at ITR. So when we look at these different leading indicators, we're getting a wide swath of different inputs. We're getting traditional leading indicators put together by us here at ITR, such as our ITR leading indicator, our financial leading indicator. We're getting leading indicators put together by other firms as well. We don't just trust our own leading indicators. We also like some that are put together by the OECD, by the ISM, like I was mentioning with the PMI. And then we also look at other elements that are really important to the economy too. The Wilshire Total Market Cap is a measure of the stock market. Business confidence is an important predictor. Housing market is a huge important segment of the economy and tends to have a leading relationship to the overall macroeconomy. Utilization rates, that's really important. When utilization is high, economic activity tends to be on the upswing, and when it's starting to wane, economic activity tends to ebb. And then exports. And so by looking at these wide variety of highly statistically significant predictors, and we look at a dozen, not just one or two, we get a sense of where the economy is headed. And really the thing to note here is simple. When you look at the trend is down, and that means lower growth rates. So slowing growth or recession, and it really depends what part of the economy you are in that will determine whether you're going to just have some slower growth or you'll have a mild recession. So let's take a look at the overall economic picture. So when you look at real GDP, that's what's plotted on the screen here. So this is adjusted for inflation, it's real. What you can see is, first of all, there's the huge downturn right about early 2020 when the economy shut down. And then this very, very rapid recovery. I want you to pay attention here to how quickly we recovered from COVID and the COVID-induced downturn versus how slowly we did coming out of the Great Recession here. A very rapid economic recovery. And of course, that was due to lots of different things, but a big part of that was how aggressively the government responded, both the Federal Reserve with monetary policy and the government with stimulus. And now we're kind of paying for the overhang from that as monetary policy tightens up a little bit, but particularly with the stimulus no longer there, we've had higher inflation that eats into real economic activity. And we've also had some areas of spending cut back a little bit. Overall, spending is doing fine, but when you look at certain areas that maybe had a real stimulus-induced boom, now they're seeing, of course, that can't be maintained now that the stimulus payments are no longer there. And so we've had some very mild contraction here in GDP here in the first and in the second quarter. So business inventories is a part of that explanation. Trade deficit, because the dollar is so strong and we're demanding so many goods here in the US, we've been importing a lot, and that actually counts negatively for our GDP. Whereas the rest of the world hasn't recovered as strongly economically from COVID, and so that's a negative. But when you look at it from a big picture, the decline has been mild. We do have 2 consecutive quarters of GDP decline, so by some definitions, that's a technical recession. But from a pragmatic perspective, when you look at consumer spending and you look at employment and you look at business-to-business activity, there are some encouraging trends there. So, is it a recession? Is it not? Really what we want you thinking about is not that question so much, but how is your business doing? how are your markets doing, and what are your fundamentals that are driving your business and your industry. And of course, we're going to go into those here later. So in terms of that, one of the drivers of the economy, we want to look at real personal income. And I think this really tells the story of the stimulus. When you look at the top line, that's that teal line, you can see that the income trend just went crazy, very, very positive when those 3 stimulus rounds came out. And now, of course, as those 3 stimulus rounds are over and those payments are being withdrawn, we are seeing that real personal income come back really in line with its long-term trend. It's not cratering, it's just coming back in line with what the long-term trend was, but for the stimulus. What we like to look at here at ITR, because we can't really determine precisely what stimulus is going to be passed a year from now, 2 years from now, 5 years from now, is what's the overall health of the labor market. And so to do that, we back out current transfer payments. So that includes stimulus, Social Security payments, that sort of thing. And so this is really looking at how is the labor market doing adjusted for inflation. And so personal income, excluding those transfer payments, is rising and continuing to rise. So we don't see that same resetting to the long-term trend. We just see ongoing rise in real personal income, even with high inflation. So we think that this is a really encouraging sign that overall the economy is on a fundamentally good footing. Doesn't mean that there aren't headwinds. There certainly are: high inflation, rising interest rates, and the like. We're going to go into those a little bit later. But from a fundamental perspective, the income picture is good here in the United States when you take out those transfer payments. The other part we want to look at is not just income, but what about our debts? Because people can spend their income or they can take on debt. That's the 2 main ways they have to drive economic activity here in the US. And so when we look at debt payments relative to personal incomes, right now we're at 9.52%. And you can see that that level is rising, that percentage is rising, and it's certainly up from where we were. But when you compare it to the history, we're at a very, very low percentage of debt relative to personal income. So what does that mean? It means that people can pay the debt service that they have on hand overall. Of course, there are going to be some folks that are going to struggle in a high inflation world, particularly those on the lower end of the income stream. I'm not saying that. What I'm trying to say is, from an aggregate perspective, we have a very low percentage of debt service relative to our income right now. We can certainly afford to take on more. And I'd just like to address one thing. There's some sentiment out there. Oh boy, is the Great Recession 2.0 right around the corner? Are we going to have a meltdown maybe in the economy here? Take a look at what this trend was before we had the economic meltdown of 2008, 2009. We were at a sky-high percentage of debt relative to income. We were at an unsustainable level of debt relative to income. Here, we're at a sustainable level. Now, this trend is going to rise because people, as we saw on the prior slide, adjusted when you include those transfer payments, the real personal income is going down right now because they aren't receiving the stimulus checks. So they're dipping into their debt a little bit more. So we're going to see this percentage go up. That's the bad news. The good news is people are going to be able to take that on. So if I had to really summarize these last 2 slides, when you look at a health checkup for the typical consumer here in the United States, they're not liking high inflation, that's for sure. They're not liking higher interest rates, that's for sure, but they're in a fundamentally solid position to drive the economy forward. So what does that mean? Well, it means that when you look at retail sales, this is in dollars, there are $7.8 trillion worth of spending that's gone on in the retail sector over the last 12 months. That's the lower green line on the panel on your screen there, that 12-month moving total, or 12 MMT. What is that? Well, that 7.8 trillion you can see is of course a record high, by far and away a record high. And not only that, it's up 13.2% year over year. That's our 12/12 rate of change on the upper panel in the screen. On a quarterly basis, the most recent 3 months are only up 8.5% relative to those same 3 months a year. That means our quarters are coming in a little bit softer than our years. And you can see that the growth pace of growth is beginning to diminish. We're not able to grow as fast as we were. Growth is slowing, but it's still growth nonetheless. And that's because we have a strong labor market and we have manageable levels of debt here in the United States. And so people can go out and they can spend more. I would be remiss though if I didn't talk about what would this trend look like adjusted for inflation. And there you can see instead of an 8.5% 3/12 rate of change, that quarterly growth rate, you would see pretty much right on the zero line. And so adjusted for inflation, we are seeing that retail sales are flattening out. That's part of why that GDP picture I showed you earlier has not the same bullishness here because it was adjusted for inflation that this retail sales graph has with inflation included. And so really what it comes down to is this: people are going out there and they're still spending a lot of money. It's just a lot of it is being eaten up by inflation right now. So let's take a look at inflation. So here's the consumer price index in blue, 3/12 rate of change. So what you're looking at is the most recent 3 months of the producer price index compared to those same 3 months a year earlier. And so right now we're right at the crest of the inflation cycle. You can see that peak over here up off to the right-hand side of your screen. And then you can see the dots representing the upper and lower bounds of our forecast range. And the good thing is we're going to be seeing disinflation, which is fancy economists speak for easing inflation. So we're still going to see price levels go up, but the rate at which they're going to go up will be more modest than it has been. Why is that? Well, a number of things. What caused this to go up so aggressively in the first place? Supply chain being very tight because supply was low and demand was extremely strong. Why was demand extremely strong? In part because of the stimulus. We know that that effect is fading. In addition, we know that firms are increasing their capacity and so supply is rising. And so when we look at the supply chain pressure, that trend is getting better. So this blue line represents the global supply chain pressure index. The more it is above zero, that means the tighter the supply chain is, the more demand there is relative to supply. Zero represents average supply chain pressures, and then negative supply chain, like we saw here around on the Great Recession, means that we had actually excess supply relative to demand. So the fact that this line is going down means that we're seeing the supply chain normalize. It's not normal yet, that's still clearly a very high level, but it's moving toward normal. And when we look at that purchasing managers index, which is a 7-month leading indicator, the decline in that green line means the blue line is going to keep moving down for about the next couple of quarters at least. And so we're going to be getting closer and closer to a more normal supply chain. That's going to help with our inflation picture. So when we go back to this prior slide, we're going to see that inflationary pressures are going to get more and more normal, but they're not going to get totally normal. We're still going to be at an elevated level of inflation here, an elevated rate of inflation, I should say, relative to where we were in the 2010s. Much lower inflation, 1%, 2%, 0% inflation was more the norm. Here we're going to be more at 3 or 4% as the norm. Why is that? Tight labor market is a chief reason. We're going to be having these labor costs continue to be passed through, and that's going to make things expensive. So another reason that we're very confident that the inflation is going to be easing is government spending. Again, that's part of the story for why we had the decline in first quarter and second quarter real GDP here in the country. And when we look at that spending trend relative to inflation, the good news is it leads by a lot. And so the fact that government spending is coming back to earth a little bit means that we're going to see more modest rates of inflation going forward. And so that's a good sign for all of us who are very, very tired of these very, very elevated inflation rates. Now, one thing I did want to address was your industry specifically. So let me see if I can actually do this. Bear with me one moment. So you should be seeing a FRED graph, Federal Reserve Bank St. Louis graph, that shows the producer price index for metal heat treating specifically. And what you can see there is clearly the price level has gone very, very high. You already know that probably. In terms of what is that rate of inflation right now, it's a little over 14% for the metal industry. And we're still seeing some pretty strong trends in there. But what I can say is going forward, we're going to be seeing more modest rates. Deep into this year, we'll start to see some relief, and especially next year in 2023, we'll see inflation ease. I think there's light at the end of the tunnel, but we're going through the painful crest right now of that inflationary trend. So we'll see some disinflation, some easing inflation going forward. May even see a little bit of deflation depending on how much some of the commodities come back down. We'll just have to see, but definitely some better times ahead there. One other question I got that I wanted to address was what actually goes into this index and how is it weighted? We don't get perfect information on how this is precisely weighted from the BLS, the Bureau of Labor Statistics. What we know is how they go about it is they look at what are the different components that go into the heat treating, and they weight those different components based upon the survey data that they get. So, as they update that data, they will revise this index. But overall, that's really how they go about doing it. And you can read more about that if you're interested on the BLS website. But I certainly would, keep in mind, you can find this. I just found this by Googling producer price index metal heat treating. You'll be able to find this chart in just a second, like I will as well. Okay, so let me try and find my Zoom here. Okay, so easing inflationary pressures, that's what's going to be going on going forward. So let's move along to non-defense capital goods new orders. This is a key indicator for you all because this compares very, very well to the industry data that we forecast for you. And what's going on here? Well, we have a very nice rising trend in the 12-month moving total. And when we look at the rates of change, we see this classic slowing growth profile where you have the 12-12 rate of change coming down, the 3-12 rate of change coming down and below it. Quarters are coming in softer than your years. And so we're going to see slowing growth here in non-defense capital goods new orders into the second half of 2023 before it picks up again. Now, if I were to show you again the deflated version of this series, it would be very different. We would have on a 3-12 rate of change, again, about a flat number, right about the zero line, because most of the B2B orders right now are getting eaten up by inflation. And so certainly we're seeing some softening in the trend. It's more pronounced on a volume basis than on a dollar basis. And if you haven't gleaned already, this is certainly a trend that we're seeing across the economic indicators right now. Okay, so really in terms of how the data looks, the May data was average, the June data was median. We really have a pretty normal looking relationship here. It's just the problem is most of those gains getting eaten up by inflation. So we will see this trend flatten out a little bit in terms of looking into next year before it picks up in 2024. And you'll see that mimicked in your forecast as well. Now, how do we know that non-defense capital goods new orders is going to do this? Well, let's look at this relative to the Purchasing Managers Index. That was one of those 12 key leading indicators I was talking about earlier. And you can see here that the decline in the green line, and it shifted forward to reflect the lead time from the PMI to new orders, is foreshadowing the decline we're going to see in the growth rates for new orders. That's the blue line, and those dotted balls represent the upper and lower bounds of the forecast range. So one question sometimes I get here is, oh my gosh, that PMI reading is below the zero line. Does that mean we're headed toward a bad recession? No, you can't look at the PMI that way. Just look back at 2004, 2005, 2006. PMI can go below zero and we'll still have overall growth in dollar-based new orders, B2B spending. You have to do more work than that to figure that out. So when we do our forecast for new orders, we're taking those trends into account. This is just one indicator, so we can be very confident that orders will be on the backside of the business cycle, slowing growth or mild recession. And so then just to determine which side of that coin is it going to be on, we have to look carefully at other things like the inflation probabilities. Industrial production here, this is adjusted for inflation, and we're going to see rise here through 2024. Part of that's going to be a function of reshoring activity. People are certainly going to be looking to bring things closer to the consumer here to shorten that supply chain. Another factor behind that is just going to be the very stuffed backlogs that we have here. And as the supply chain untangles, I was mentioning that earlier, we're going to see industrial activity continue to rise. Another part of that is going to be oil and gas. We've all seen the prices for oil. They've come down a little bit of late, but still very, very high and certainly profitable if you're an oil driller or you're a natural gas driller. And so those producers are going to be out there juicing that segment of industrial production, as well as the equipment that's needed to do that extraction as well. So that part of industrial production is going to be doing very well. So put it all together, what's this mean for the economy? It means that some markets are going to have soft landings where we avoid recession, and others are going to have mild recessions. Mostly mild recessions are going to be the order of the day if you don't have some slowing growth. So when you look at the overall consumer and the overall standing of businesses, none of them like inflation, none of them like higher interest rates, but in terms of the cash they have on hand, the how their balance sheets look, consumers are in good position to weather this storm. Businesses are also in a good position to weather this storm. And so that's going to keep some things in slowing growth, others are going to have recessions, but it'll be pretty mild. Right now, I've shown you a number of charts where we're having this big discrepancy between dollar-based measures and volume-based measures. Make sure you're tracking your company data both ways, because you want to be able to catch those trends. As inflation moves along the backside of the cycle, we're going to see those inflation rates come down. As I showed you, this discrepancy isn't going to be as big, but we're not going back to the really low inflation period of the 2010s. The labor market is just too tight for that. And so we're going to see inflation be an ongoing issue, just not quite as robust as it is now, thankfully. And so you're going to want to be making sure you're paying attention to volume. You're also paying attention to the dollar-based measures. And then you're going to want to know your markets, because some of these markets are just going to have slowing growth. Some of them are going to have a little bit harder time. One general rule of thumb, if it was a market that really benefited from the stimulus of 2020 and 2021, it's more likely to have a recession in 22, 23 because of the bounce, the pullback toward normal. If it didn't benefit quite as much, oil and gas is a good example of that. Oil and gas actually had a pretty hard time in 2020, 21. It's more likely to just have slowing growth. And indeed, that's what we're expecting for oil and gas. Second bullet, be careful, be cautious, but don't be overly conservative. You need to be careful because we have a economy, and I'm going to be showing you in just a second, where the Federal Reserve could absolutely tighten us into an overall recession. And we could see fewer markets in slowing growth and more markets in recession or even moderate recession, mild or moderate recession. That's a risk to the forecast. And so you got to have some cash on hand in that case. But at the same time, when you look at those consumer and corporate health metrics, they're so strong that we think some people are going to turtle up and just be too conservative in their business planning. And we don't want you doing that. What we really want you focused on is deploying your capital judiciously to do things that are going to protect your margins. Because when you look at the cost pressures that are going on right now, it's squeezing margins, squeezing margins, squeezing margins. Customers are getting more price conscious because of inflation and as we see the economy weaken here. And so that's a recipe for certainly some margin pressure, regardless of whether you have slowing growth or a mild recession in your end use markets. So really think bottom line and how you can deploy that capital judiciously and carefully and effectively to help you be profitable. That's the takeaway. Okay, let's move on to interest rates here. When we look at the long-term bond, 10-year bond, and keep in mind corporate debt tracks this very well, you can see we're just a shade under 3% right now. Boy, is that up a lot from how it was certainly in 2021 or especially 2020. But when you look at it back to 1980, as I have it on this chart here, you can see it's really not that bad. We still have manageable interest rate. We've certainly paid 2.8% on the 10-year for a long time. And when you compare that 2.8% to very high inflation rates, for your industry over 14%, it looks awfully good. When you compare it to some of the labor expense increases that we've been seeing, it looks awfully good. So this is to say, if you find a way to invest in your company to protect those margins, to cut your costs, to be more efficient, borrowing to do that is not the world's worst move. What is concerning, though, is that we're seeing the spread, the difference between the 10-year yield and the 3-month yield get awfully close to inversion. And what does that mean? Well, it means when you see short-term interest rates go up more to be higher than long-term interest rates, that's a bad sign for the future. And that could mean that the economy could be over-tightened into a more broad-based downturn. And so we're keeping a very close eye on whether or not we see this trend invert. If we do, that's going to be problematic. If we see it for 2 to 3 months sustained, that's when we get really worried. The good news is once you see a yield curve inversion on the 10-year to 3-month, it doesn't mean that the economy is doomed tomorrow. Typically, it's around 15 months between the time that we've had a yield curve inversion for a few months. So even if it happened tomorrow, that's not going to happen until, say, let's see, middle of October, say, we could have a yield curve inversion in place for 2 months, hypothetically. You'd have to go another 15 months plus or minus to get into where it really hurt the economy. So that's sort of the saving grace here. Why do we look at the 10-year versus 3-month? That's the most statistically significant in terms of a macroeconomic signal. So what can we expect for interest rates? Well, if you look at the Federal Open Market Committee dot plot, each one of these dots represents a voting member for the interest rate determining members of the Federal Reserve. And clearly they're expecting higher rates, not only this year, but next year as well. Don't take this as gospel. They're always changing their minds, especially now. Chairman Powell was pretty transparent about they're going to react to how the data is going to be coming in. And we think that data will be showing disinflation, easing inflation. And so they might back off a little bit, but certainly higher interest rates are part of our future. So think about how can you use that to your advantage, some ideas across there on your screen. Okay, let's take a quick look at demographics and wages before we get into your markets. So first and foremost, how is that labor market looking? Well, when you look at the number of people that are unemployed relative to the number of job openings, we have almost 2 job openings for every 1 unemployed person in this country. The ratio is 0.6 to 1. So definitely a market that's in favor of employees. And when you look at on a graph of job openings, that's the orange line here, and the enormous gap between job openings and employment, that's the blue line. Clearly, that's going to mean that firms are going to have to pay out some very significant wage increases to attract workers or to retain their existing workers. Well, the good news is when you look at the quit rate, that's the teal greenish line here on your screen, and you look at it compared to the employment cost index, that's in navy, you can see that the quit rate is beginning to edge down. Why is that good news for employers? Well, when employment quit rates begin to edge down, we see the rate of rise in employment costs begin to come down. So wages aren't going to be going down, but we'll see slower wage gains as we look out into 2023 than we've had here in this very painful period for employers where we've had really significant wage gains amongst employees. So, in terms of what you can do to combat this problem, you have to treat your employees really like a asset. Make sure that you're giving them a great experience. That means a great manager. It means a career path. It means making sure that their work is as interesting as can be possible, that they have a strong company culture to go and rely on, that your wages are competitive and they're going to be going up, maybe not up as fast as they were this year come 2023, but they'll still be going up. And the tight labor market is going to be a feature of our landscape for many years. And that's because it's a very multifaceted problem. You're looking at demographics, you're looking at baby boomers retiring, and you're looking at a smaller generation coming in. You're looking at incredibly expensive childcare. And so some people are staying out of the labor market to take care of their kids because of that. You're looking at all kinds of other issues as well as to why we have this very tight labor market. And it would require fixing a lot of those issues significantly to see a much different calculus. So, you can imagine, just to go back quickly, that this gap may close somewhat as we move along the backside of the cycle a bit, but to see it just disappear entirely would be really something else. And so certainly the calculus is going to be in favor of the employee, not the employer. That's the bad news. Okay, let's get to your data. So when we look at what do all of these trends mean for MTI, we think it means slowing growth this year, a very mild recession next year, and then a bounce back in 2024. And so that's our forecast right now for MTI average monthly sales. And so as you look out there, we want you to be thinking of that as your industry benchmark. So let's take a quick peek at some of your markets. So when you look at construction machinery new orders, this market is going to be overall on the up over the next 3 years. You can see the 12-month moving total screen on the left-hand portion of your screen. And that has a little bit of a dip here, a little bit of a mild recession pullback before we claw through and see spending move higher. That's going to be twofold. We're going to be looking out there and seeing people rent more equipment than buy new equipment. And that's just because of all those cost pressures we've been talking about: inflation, higher interest rates, higher labor costs. People, when they combine that with some softer economic times, they're going to be more apt to rent rather than place that new order for that new piece of construction machinery. The other part of it is, let's look at the construction industry itself. And while the non-residential side is going to do pretty well in 2022, 2023, we're certainly seeing a pullback in single family housing in particular. And so some of that development is going to see a pullback in demand. And so we'll see a more flat 2023 overall, mild dip for a little while, a little bit of growth. For the year as a whole, it'll basically be flat versus 2022 before we bounce back there in 2024. So this market really will mirror MTI as a whole, or the other way around, depending on how you want to look at it. When you look at North America light vehicle production, that 12-month moving total on the left-hand panel of your screen, you can see we are way below where we were pre-pandemic. And that's to say nothing of where we were back in, say, 2016, when the auto industry was really firing all cylinders. That's not a demand problem, it's a supply problem. Certainly semiconductor chip shortages have been one of the most significant supply problems for the auto industry. It's still pretty rough out there for the auto industry in terms of supply, but we're starting to finally see the semiconductor issue get a little bit better. We saw a 1-day improvement in overall semiconductor lead times. And by improvement, I mean the lead time began to go down a little bit, so people weren't waiting quite so long. 1 day isn't very much, but it's a step in the right direction. And as we see these fabrication plants come to fruition 2023, especially 2024, we're going to see some better availability on that semiconductor side. So what does that mean? Well, it's going to mean that the data trend is going to be moving up here for North America light vehicle production over the next 3 years, because it really can't be much worse than it has been here for 2020, 2021, and first part of 2022. But we're certainly not going to get back to the record high level anytime soon. So we're not projecting record highs through at least 2024. So growth here, but from a relatively low level of activity. When you look at heavy duty truck, it's really a very similar story, right? We're not anywhere near record activity. Supply chain issues are causing problems in this industry, and we'll see growth, we believe, throughout the next 3 years. Certainly much more modest growth in 2023 because the macroeconomy will be softening. But as the supply chain untangles, those orders that have already been placed will be put through to fruition. And certainly when you look at wholesale trade right now growing very, very rapidly, there's certainly need to move things about the country more. And certainly the trucks are going to be a part of that story. So moving on to oil and gas, this is going to be one of your relative winners. Very, very high oil prices, very high gas prices as well, are going to make this profitable. We're exporting as much LNG as we can to the rest of the world. And then here at home, we're certainly have a healthy appetite for it as well. And so when you look out for the next 3 years here, it's a growth story for oil and gas production. On to medical equipment. This market is going to be overall growing. We're going to see a little bit of a pullback in the 12-month moving average. You can see up there next year. But on the whole, this is going to be a growing market. When you look at medical expenditures, they're rising. People are getting back to normal after COVID. They're making those appointments with their doctor and at the hospital again, and that's driving this industry higher. Certainly, things will be slowing overall in 2023, though, because we're seeing while those expenditures are growing, they're not quite growing at the pace that they were. So overall, a good market to be in, but a bit of a stumble next year, bit of a almost a hiccup amongst the overall growth trend before things get back on track. By the way, as we look out to the future, think of things like medical as an opportunity to diversify your business. You can see the headline there, somewhat insulated from the macroeconomic cycle. The correlation between medical equipment production and GDP or non-defense capital goods new orders or UAL is pretty low. And why is that an advantage? Well, what it means is when the other markets dry up, when we have tough times in some of the other traditional metal treating markets, there's opportunities there to kind of have a cushion, a secondary market in medical that can kind of cushion some of that downturn. So this is a market that if you haven't explored doing more business here, baby boomers are not getting younger. Certainly they're moving closer and closer to retirement. They're going to have more health issues. That's going to mean a significant challenge for the medical industry to meet that demand. That's going to mean there's business there to be done. And so something to consider if you have the ability to get into this space, if you're not already in this space, it can kind of balance out the other markets that you already may play in. Aerospace, this really looks a lot like automotive as well, right? We're way below record levels here, but we're beginning to claw out of things. We'll be seeing some general data trend rise through at least 2024. Next year is going to be pretty flat because of all the problems that the airline industry has been having. But overall, the data trend is rising, but still, we're not anywhere close to back to record levels. It's going to take some time before we can even get part of the way back within the aerospace industry. And then another market just to consider as you do your planning is computers and electronics. Here we are seeing the trend move into phase C, slowing growth. So we'll see a more modest growth rate in 2023 than we do here in 2022 before growth picks back up here in 2024. In terms of why, here I'd be looking for firms to not be as generous with their IT budgets and their expenditures, consumers as well, because of the economy softening up, that disposable income and sort of more extra spend is going to be a little tighter to come by. But overall, that's going to be a temporary thing given the health of businesses and health of consumers. Overall, we certainly are going to need more computers and electronics. So that's more a temporary phenomenon than an enduring one. So just to conclude, what does this all mean for your markets? Well, there's a number of markets where you have supply side issues that are constraining them. And those markets are going to be growing as those supply side issues ameliorate. And so auto will be rising, heavy truck will be rising, oil and gas will be rising. Oil and gas will be at record levels. Medical will be at record levels for most part, whereas some of the others, aerospace, heavy truck, right, those aren't going to be at record levels. So you have different chunks of markets operating at different paces here. And so on the whole, what do we think that means? Well, we think it means mostly slowing growth with a little bit of mild pullback for MTI sales. So looking forward to the future, businesses are not always going to be in such a strong financial position. Consumers are not always going to be in such a strong financial position. And as we look deep into this decade here, we're going to see interest rates be generally rising because we're going to have to combat inflation. We're going to see inflation be generally higher in the 2020s than it was in the 2010s. Why is that? Labor costs for one, commodity prices. We've underinvested in a number of commodity production areas, oil being one of the most prominent ones. And now we're starting to pay the price with these higher prices. And so it's a more inflationary, higher interest rate world that we're moving into. And what does that mean for the consumer and for businesses? It means that over time, this strong financial position that we're in now is going to be sapped. And so we think there'll be a more significant recession around 2025. Could come as early as 2024, could come a little bit later as well into about 2026. But by around that time, we're going to be seeing inflation and interest rate pressures erode the health of consumers and businesses. So what does that mean? Well, it means that you need to have a really diversified book of business. You need to make sure that you aren't just solely beholden to one market, but you are in markets like medical that maybe aren't as cyclical as something like construction machinery or something like that. And then the second thing I would like to note now is just to make sure that you use some of the pessimism that's out there right now to your advantage. Some business leaders are really concerned that we're headed into a horrible style recession. And I've just showed you those charts of how strong the consumer is right now. And as the consumer goes, it rises, rising tide lifts all boats. And so as the consumer goes, so goes the US economy. And so some of those folks who are in this really pessimistic position right now are not going to be taking some of these investments. They're not going to be hiring as much. We want you to be thinking about, making sure you have those really good players on your team, because we're going to have a tight labor market for the foreseeable future. You're going to need to be investing in efficiencies. And so keeping your eye out as we move into 2023, and some people get really, really nervous for deals or good employees that may become available, be opportunistic there and use that overall pessimism to your advantage. Last, before we get to some questions, what are some things of the business cycle that you need to consider right now? Well, I would say, certainly paying attention to your cash position, number two there. You cannot have too little liquidity as the business cycle weakens into next year. You want to have sort of a nest egg if the Federal Reserve over tightens us into a recession. You don't want to be caught unawares. At the same time, you want to revisit your capital expenditure plans there. Make sure that you're spending money on improving your efficiencies, making sure that your labor, you're running a lean labor environment because it's expensive to have workers right now. It's hard to find them. So don't cut it to zero, most likely, but neither should you be spending excess money. You want to be making sure that you are really judicious in how you approach your money. So some other things to look at here. Some of these will be more relevant to you if you are headed into some of those markets where we're going to see recessions, like I just showed you, versus some of those markets where you'll just have slowing growth. Like if you're an oil and gas person, you might be feeling a little better off than someone who's headed into recession. So as we look ahead, we're heading into this inflationary world. Make sure that you do something really, really well that can justify those price increases. Otherwise, you're going to have a hard time increasing your top line as fast as your bottom line is increasing. And that means your margins are going to squeeze, and that's just going to make life harder for you. Certainly investing in automation there, we've already touched on that. And the macroeconomic risks, this is what I was saying earlier. We're not always going to have a strong consumer and a strong corporate balance sheet. Those particularly now in 2025 and 2026. But if we see the Federal Reserve over tighten, we could see it happen a little bit earlier. So just be prepared for that possibility. That's not a tomorrow possibility. It's a longer term phenomenon. And so take this time to get ready for that time. So with that being said, I'd love to take any questions. If anyone has any, feel free to drop them in the chat, or if you'd like to unmute, I would be happy to entertain any questions that you all might have. Okay, sounds like maybe some silence here. So hopefully I answered everything you were looking for. If you have any questions, feel free to drop me an email. My email is epost@itreconomics.com. So EPOST@itreconomics.com. I'd be happy to answer anything that you have. But good luck out there. I hope this was helpful, and I hope you have a great rest of your Thursday. Take care, everybody.